But it would look like, let me take you back, I need to take you back to the issue of Greece. It would look like the firewall that the EU has tried to build around Greece and Portugal has failed, and this cancer seems to be spreading. We've been talking about contagion issues. It went away a few months, but we're back at that issue of contagion. We're back at that issue of Greece facing an imminent default. We've not seen Greece implementing those austerity measures in return for the money, 110 or 109 billion euros that they're asking for.
Esther, let's come back to the basics. Let's look at a situation where Germany has tax for the companies in Germany below 20%, which is one of the lowest in the Eurozone area. Let's look at the fact that Germany is strict on outsourcing manufacturing out of Germany for the companies in Germany. Let's consider what is Greece producing as a nation, what is Portugal producing, what is Spain producing. Most of these nations are tourist nations. And if you look at it, you realize that tourism has moved from Europe to Asia. So they've lost a lot of revenue in tourism, right? Fueled by the fact that there's very high unemployment, there's instability in Europe. Let these nations come back to the drawing board and ask themselves, what are we producing? How can we stop our companies from outsourcing the little production we have abroad to save costs? So corporate interests, making a lot of gains, sacrificing national GDP. These are issues that needs to be addressed. Just like Germany is addressing it, and that's why Germany is the strongest nation in the EU.
But the Germans pay taxes, of course, we know that, but we know that's one of the issues why Greece is where it is today. They're not so keen on paying taxes.
They pay tax because the companies in Germany are doing well.
Okay.
It's one thing for you to be doing well, it's another thing for you to pay tax. You can't pay tax if you're not doing well. People who are out of jobs can't pay tax. People whose salaries are being cut can't pay the tax that the government is expecting.
Okay, now let's move away from that. Let's go now. Of course, during the week we heard talks that China may be considering some investments in Italy, or that Italy has reached out to China to come buy some of its bonds and invest in some of its sectors of its economy. Now let's analyze China's role in stabilizing the Eurozone, and of course the big question stands, what's in it for China?
Premier Wayne has said that the EU needs to address fundamental issues like we've been discussing, but you know, on Tuesday, Yu Yudong, the former advisor to the People's Bank of China, came out and said, he's currently a professor in the Chinese university, came out and said that the leadership of the Chinese government should be very careful about investing in Italy and other European nations, because the ECB seems to be in disarray. Individual European nations and ECB, in its exact words now in an email, seems to be in disarray. So that clearly spells to you that even though Zhang came out yesterday and said that China is considering supporting some of these EU nations, and to me, China is obeying the principle of buy low, sell high. Buy when there's blood on the streets and sell when their greed overtakes their ego. China is just doing what Warren Buffett has done so well in the last 20 years. But I don't think China singularly as a nation that has a lot of cash to play with right now can stabilize the Eurozone. I think the issue is not with money. The issue is with fundamental structural changes. So it's like you putting money to a dead end.
So you're saying right now that Europe should Europe embrace this help that China is maybe offering?
Europe should embrace it, but at the end of the day, we can't deny the fact that because there is lack of investor confidence in the markets, the yields on treasuries are going to keep rising. The expectations of investors who invest in these government bonds are going to rise, and government has to pay because it's a free market.
Okay, let's talk about what China is asking for in return. Of course, we know there's no free money, there's no free lunch out there. Now, China is maybe asking, analysts say that China may be asking for an arms embargo, Europe to lift an arms embargo and acknowledge its market economy status. Now, this is one status it's been asking for from the US and Europe for several years now. Do you think that China may eventually get this?
Well, it's a tough bargain, but I think he who has he
who plays the pipe or dictates the tune.
Dictates the tune. I think they will have to concede to it. But where I see issues is where China is saying that the EU should acknowledge its market status. I see issues with that. When you consider that China recently asked the IMF to include it in the special drawing rights of the IMF basket of funds, but China is not willing to allow its exchange rates to move from fixed to floating exchange rate system until 2015, then that is an issue. Until China accepts that it has to move its exchange rate from fixed to floating and allow the renminbi to float in the free market and allow the market to determine the price of the renminbi per time, we're going to have issues with whether EU can acknowledge it as a market status economy right now.
Okay, now some analysts say that China can't bail out Italy or any other European nation any more than the EU can. Do you agree with this view? That it's going to start from, the house cleaning is going to start from within and perhaps stay within, that's within the EU, fixing the problems within its own household?
Esther, I'll give you a simple example of why I agree with this. Sometime in 2009, Coca-Cola wanted to acquire 100% the largest fruit juice maker in China called Hujuan, a stock that has been acquiring over the years gradually. Coca-Cola, as at then, had about 45% and wanted to acquire fully. And when Coca-Cola brought in $2.5 billion to make a full acquisition, the Chinese government said that because of political reasons, that they won't allow Coca-Cola to acquire that company in China. I think politics is going to come in again here, and the EU will make more political decisions than market decisions. The EU will restrain China to some level on how much it can invest in Europe and the effect of it allowing China to go full-blown. The political effect, when you consider that China is a communist economy and the full motive of the Chinese government is not fully known globally, right?